Good morning, y'all. My name is James Neathery. Look, the reason we're here is because y'all are creative people, you're outside of the box thinkers, and you're getting it done. Who shows up at 8:30 on a Saturday morning? Seriously. So we're appreciative that you're here. And what I'm going to share with you today is the infinite banking concept, a little about me. The challenge I feel that I have is bringing numbers and concepts together because this is very conceptual. And I don't want to oversimplify with concept, but I don't want to beat you up with numbers either. I married a beautiful lady from West Des Moines, Iowa. She's an English major, right? When I talk about numbers, I can make her eyes glaze over fairly quickly. But then when she corrects my English, my eyes glaze over pretty quickly too. So I'm going to seriously try to find a balance. I think I've done a pretty fair job of doing that. And then my portion is an introduction to the infinite banking concept. And briefly about me, it's not about me. This is about a concept that everyone in the room should investigate with an open mind. I'm over 25 years in the life insurance industry as a life insurance agent. I'm proud of what I do. I'm also an investment advisor, and I was 14 years in my profession, at least moderately successful. $1 million round table producer, top 5% in the world. Maybe not the first guy in line, but I wasn't the last guy in line, right? And I've always been a student of my faith, my profession, economics, and history. And so about 14 years into my practice here, I'm being a good student so I can take real solutions to my clients. And I'm at a 2-day seminar, a venue where outside speakers from all over the country came in, and they were sharing their best ideas, practices, and being a student, I'm taking copious notes, and then I bought all the books that all the speakers referenced. I took all of those books home. And, when you deal with numbers all day in the office and you go home at night to read more numbers, you're essentially trading family time for just more numbers, right? So that stack of books was on my nightstand, and I'd start reading one and not finish it, and I'm a reader, right? So I'd start another book and not finish it, and it was probably 3 months on my nightstand before I even began to read through the stack of books. And then I started this process of starting without finishing a book. And I got down, I don't know, probably started without finishing about 5 books. Now, you're seeing that stack every night, and I'm feeling like a real underachiever now, right? So I go through the stack of books, and I picked out the thinnest book in the stack, only so I could finish reading the book. Right? And it was 92 pages, big print, lots of illustration, blank pages, and I could not believe I was able to read it that night, right? And I'm feeling like I'm achieving something. 14 years in my profession, I was as angry as you could be. Had no idea that this concept existed. Had no idea what you could do with life insurance. And just couldn't believe it because I've been a student of my profession in history and economics, right? That was over 11 years ago. That next morning after I read the book, I'm like, oh my God, my clients have to see this. I can't believe this, right? So I'll call the number on the back of the book. I'm going to order about 10 books, take them to some clients that I greatly respect and understand money and cash flows at a pretty good level. And the author of the book, Nelson Nash, answers the phone. And we had a good conversation, and it wound up like this. Boy, I do these 10-hour seminars all across the country, and you need to get yourself to one. All right. So I ordered the 10 books. He shipped them to me, and I got myself across the country to the next event that he was speaking at. Right? Went as a student, took copious notes. When I returned home, I restructured all of my life insurance and most all of my investments. And then I've been teaching my clients how to implement this concept where they're at ever since. Okay? So thank you for letting me share that. I like to share it. I like to practice. I think you ought to hear it, but I need to hear it as much as you. Okay? All right, so you got to kind of have a comparison, or sometimes it's easier to understand a concept or see some value in a concept if you have something to compare it to. So I'm going to compare this concept with qualified retirement plans. All of y'all know and understand qualified retirement plans, probably at various levels. So some of this you already know, there's no question. But I want to look at qualified retirement plans because most all of America holds the majority of their wealth in their primary residence and a qualified retirement plan. Okay? So we have a place to start from. And I'm mic'd up here for one reason. We're going to make this available for y'all later if you want to access it, and you think that I misspoke or didn't understand something, by all means you can go in there and dissect it. I challenge anyone in here to take this information and prove me wrong. Prove this concept wrong. Right? You'll be better for it. And I would too. Okay, so we're going to start with qualified retirement plans because this is where the majority of Americans build their wealth. Well, let's just take a really kind of a deeper look at the qualified retirement plan. And I'm mainly talking about the traditional plans, the 403Bs, 401k, the IRA. We're going to talk about Roth IRAs, but I'm mainly going to start with the traditional plans because most of us, if you're depending on your age, we didn't have the opportunity to invest in Roth IRAs and Roth 401ks. The tremendous amount of the money is in a traditional IRA and a 401k. Okay. Now, they beg three questions. Traditional qualified plans beg three questions. Number one, are taxes going to be higher in the future or are they going to be lower? You tell me. The bona fide question. Taxes going up or are they going down? They're going up. Look, I got a 1913 1040 form here. So, the IRS, the federal income tax, has existed for, I think I can blow that up, for 103 years. Right? Exemptions change, exclusions change, carryovers change, all deductions change, but the net amount that we as average individuals are paying in taxes continues to go up. And I'm not saying y'all are average. I don't believe that for a minute. I'm talking about the average all-American family. I believe y'all are above average, and that's, without trying to patronize you, that's why you're here, right? You know how many people should be here this morning? Oh my goodness, not just for us. I'm just saying for the opportunity that Tim provides. Okay. Of course taxes are going to go up. All right. The second question, would you rather pay taxes on the seed or the harvest? A little or a lot? The seed. Well, now if we look at that, if we have a linear return, if I can get a 7% actual rate of return year over year over year over year over year forever, it wouldn't matter. Taxes up front or at the end. But your returns don't come that way. It could be 20% this year, -5 next year, 15 the year after, 4 the year after, 3. All right. A variable rate of return, it does matter. You'd want to pay taxes on the seed. Right? Okay. A little versus a lot. Now, the third question, is $1 worth more today or in the future? Today. It's always today. And the way I use the example, when we were a kid, how many candy bars could you buy for $1? You could buy a handful. There's no question. You keep buying candy bars all your life. This is what happens. Right? So you should be buying apples. You know how many candy bars can you buy with $1 today? 1 if you go to the dollar store. Right? But health, you should still be eating apples. An apple a day absolutely does keep the doctor away. Right? Okay. So $1 is always worth more today compared to the future. So the qualified plans violate those three truths. Right? You're going to be in a higher tax bracket in the future. You're going to pay taxes on a larger amount if the underlying investment is successful. Right? And y'all, I understand in the real estate industry, you're trying to do something about that rate of return in your qualified plan. You don't trust the money manager 5,000, 3,000, or 4,000 miles away. You, with your own God-given abilities and talents, are going to go out and use that money in a self-directed account to get that rate of return. Right? Perfect. Okay. doesn't change the fact, doesn't change these three truths, then the dollars that you receive at distribution are always worth less than the dollars at the time of contribution. So now when you look at that, look, the dollar keeps going down, right? So inflation, right? An expansion of the money supply, and the effect of that is a rising cost of goods and services. And so now we're in a world that is eaten up with, ridden with the concept and the idea of chasing returns so you can outpace inflation. You can't talk to anybody in the investment world and hardly in the real estate world without talking about what's the rate of return, what's the rate of return, what's the rate of return, right? We are just trapped in an environment that we're chasing a rate of return when it comes to money. All right? Okay. Now let's look at the Roth IRA. They still violate the third principle, the third truth, because the dollars at distribution are worth less than the dollars at the time of contribution. Okay, and of course, look, your income could potentially phase you out of that participating in a Roth or limit what you can put into a Roth. The conversion is always taxable. That could be a good thing or not a good thing. It depends on where you're at, right? And then, of course, the regulations for managing the self-directed IRA, the requirements are becoming more and more onerous and expensive when you do self-directed qualified accounts, right? Okay. Now let's look at take a closer look at the timeline of a qualified plan. The example here, I've got the individual going to work at about 19 and a half, and they're either putting their money in, maybe they're getting a match from their employer, it doesn't matter. But they've effectively, for the next 40 years, locked up that portion of their capital. Right now, this is a place that the majority of Americans build wealth. They're putting money into a qualified plan, and at 20 years of age, they're effectively locking up their capital, right? Okay? Because if they access it, they're going to pay the 10% penalty, and then ordinary income taxes. Now, there's no question you can borrow against your 401k, right? There's some hardship provisions in all of them, but even that's very limited, right? But at 59 and a half, you enter into this magical 11-year period where you can have all the access you want to that capital. As much or as little, on withdrawals, whenever, how often, it doesn't matter, right? There's no limit to access to that capital, and there's no penalties, but it's just ordinary income taxable when it comes out. It's always ordinary income taxable when it comes out. It is always and forever ordinary income taxable when it comes out, whether you, the owner, takes it out or your beneficiaries take it out, right? It is always taxable. Now look, if I'm getting a tax break today, right, because I digress for a minute, but allow me. If you look at where the qualified plan came from, right, Uncle Sam, he says, well, I'm concerned about the American citizens. They're not saving enough for retirement. We don't want a bunch of old people that are dependent upon the government, Social Security, right, in the 80s. So they said, okay, well, we're going to give you a tax break today to save money for your retirement so you're not dependent, right? Now look, a qualified retirement plan, that tax benefit that you get there, isn't that an exception to the Internal Revenue Code? You're going to pay taxes on this income, but we'll allow an exception if you save for your retirement because you're not doing a very good job. Now, if Uncle Sam really loved me and had my best interest at heart, wouldn't he have just lowered my taxes to begin with? Of course he would have, right? And let me continue there. Can the Federal Reserve, the fractional banking system that we have in America, the central bank, can they print all the money they want? Of course they can. They're doing it, right? Now, if they can print all the money that they want to print, why does Uncle Sam need our tax dollars? You ever thought about that? Right? It's a fair question. I'd love to have a good answer. I mean, I have my own opinions. Okay, I digress. Now, after that 11 and a half year period, you've turned 70 and a half. In my example, I'll let you live another 30 years to age 100, right? Now you can take as much out or as little out as you want. Oh, no. If you don't take a minimum distribution, it's called the minimum required distribution on an annual basis. If you don't make that withdrawal, you can be penalized up to 50% of what you should have taken out but did not take out. Okay? Then it's always, ordinary income taxable. Now, this means that the majority of the time, if we look at the timeline on a qualified plan, the majority of that time, the plan owner is in some kind of a penalty phase. Some kind of a penalty if they make a mistake, right? Or they need access to their capital. Okay, and then here's a statistic. 45% of all plans liquidate either fully or partially prior to retirement. Then that number went up to 70% in 2009, 10, and 11. Now, why would anybody put money that they have a hard time accessing to somewhere, pay all the fees, right? Take all the risk for their, rate of return, hoping that there's something there in the future, and then access that money prior to retirement, pay the penalties, and pay all the income tax in that 1 year that they access that money. Why would anybody do that? Because life happens, right? I mean, you lose your job, there's a medical emergency, whatever, we're going to go to school, whatever the case may be. It's real life that happens where you've kind of lost control. And if you think about that for a minute, most of the time when we lose money, it's because we've lost control. Of course, we're all human. We can make a bad decision. There's no question about that. But even look at the bad decisions that we make. It's typically based on either bad information, misinformation, or greed, or fear, right? But if we have good information and make a good decision and you maintain control, you don't lose money, right? Does that make sense? Okay. And was designed for. This is easy. My questions are easy, right? Of course it's not designed for you. It's designed for Uncle Sam. That's nothing but a long-term savings account for the IRS. That's all that is. And you're paying the taxes, you're paying the fees, and you're taking the risk, right? What a deal for Uncle Sam. By the time you get into distribution, when you have a qualified plan, I don't care what size your plan is, I don't care how large the numbers are, about a third of that is going to go away in fees, and about a third of that is going to go away in taxes, even with the employer's contribution, the match to your contribution, and you're going to enjoy about a third of that on their terms. Think about that. And then, like I said, prove me wrong. I'm still a student. I don't know everything, I promise. All right, now all plans violate the law of use. Think about this for a minute. You tie your right hand behind your back for about 3 months, and you tell me how much use you can get out of it in the 4th month. You can't. Right? That's another reason for self-directed IRAs. The owner of the plan is using that money, right? Not so in the traditional qualified plan. You're violating the law of use. You're letting somebody else use the money. And I assure you they're extremely profitable. Whatever your little account statement says, not that little numbers, but they're profitable. Okay. And of course you give up, restrict, or you do give up or restrict the control, use, or liquidity of your money. The majority of the time, you're in a penalty period. In addition, of course, you always pay the fees and you assume all the risk. Now, that's the comparison, because that's where the majority of people are told to build their wealth. All right, now, we're going to compare that to the infinite banking concept. This infinite banking concept is a little bit counterintuitive. Yes, ma'am. No, my mic's not on. How about that? I thought, I'm really soft-spoken, but I thought I could, speak loud enough for the room. The mic that I have here is for that camera over there. But thank you for telling me that, or asking, okay? All right, look, the older I get, you got to have all these, eyeglasses and things like that. But, okay, so the comparison is to the infinite banking concept. All right, here's the book that I just showed you. Nelson created this concept. He discovered it in 1980. He wrote the book in 2000. Here it is in 2016. There's a lot of things out there on the internet. There's some good, some bad. Most all of it's copycat, Me Too, or some outright bastardizations. But it's okay. it's okay to look at the bad and the good, right? To make a good decision whether this concept is good for you. But, a friend told me once, James, just because you Google something doesn't mean you're researching it, right? Now you think if Christopher Columbus, if he'd have done his research before he left, floating to find the new world, what was the consensus be before he left? The world was flat. So when you go on Google and do your search, you're not doing anything but getting a gathering of consensus, right? The world was wrong, they're still wrong, and they're still wrong, right? That makes sense? Okay. Why in the world would we use life insurance? Why in the world would we use life insurance? Several reasons. It's because of the characteristics that only life insurance has. Structured correctly, right, and it's very simple. It operates like a pre-engineered tax-free trust. It's private property. The owner has complete control, use, and liquidity of the money. And then it has all of the major characteristics that's required for banking. Now, if we look at banking for a minute, words have power. Words have meaning. All right, like I said, I married a beautiful girl from West Des Moines, Iowa. Right? It snows up there sometimes like crazy in the wintertime. I mean, it snows unmercifully. And then when the wind blows while it's snowing, that snow piles up beside buildings and barns, right? Can you get a picture of that in your mind? What do you call that pile of snow that's piled up against the barn? A drift? You ever heard the term snowbank? Right, of course, snowbank. Now, if I'm going to go float down a river in a canoe, right, what do you call that pile of dirt on both sides?
Riverbank.
Riverbank, right? You probably fished from that before, haven't you? Of course, we all have. Now, if I'm going to go give blood today, where would I go give blood? A blood bank. All right, so bank can be an aggregate of any one thing, right? Okay. Now, I'm told the root word, the etymology of the word bank is bench, because 6,000 years ago, when people went to the temples to worship and pay their tithes and homage, the money changers worked off of a bench outside the temples, right? Now, if we look up Webster's dictionary today, the word bank or banking, it's going to talk about deposits, withdrawals, loans, loan repayments, the flow and the movement of money, right? Okay. So we're going to take a life insurance policy because it has all of the characteristics that are required for banking. And I think I can prove that it's the best place for anyone to put money into and warehouse their money. And if you think about that for a minute, money is not wealth. Wealth is the goods and services that money can buy. Money's a medium of exchange, right? Your money must reside somewhere. Should have a primary place of residence. Just like y'all, just like me, I have a primary place of residence. From that primary place of residence, I can go anywhere in the country, anywhere in the world that I want to go. I can take advantage of an opportunity, a vacation, and then when the opportunity is seized upon, the vacation's over and it's been enjoyed, I'm going to return to my primary place of residence because that's where I live, just like y'all. Your money is no different. It should have a primary place of residence that should be easily accessible, forever and ever, compounding, earning interest and dividends tax-free. And then when you have an opportunity come up, your money should go take advantage of that opportunity or that vacation. And once that's done, it should return to its primary place of residence. Right? Now, this is pretty conceptual, but it's simple. And I know you want to get to the numbers, and Eb Samlasky is going to get to the numbers with you. Okay? All right. Does that make sense what I'm saying? Okay. Now, for this concept to be okay, you've got to be okay with two foundational concepts. And the first one is that you finance everything you purchase. There are no exceptions. Right? You either pay interest when you formally finance, so you give up the interest you could have otherwise earned when you pay cash. So those are the two. You either pay interest when you formally finance, or you give up the interest you could have otherwise earned when you pay cash. Right? Does that make sense? Now look, the cash buyer, most of the time they are like, oh my gosh, I can't wrap my mind around that. They're paying cash because they don't want to pay anybody interest. Or maybe they don't want payments, but that primary reason is they don't want to pay interest to anyone. Okay, well, what am I talking about? What is this interest we could have otherwise earned? All right, let's look at that. This is not a new concept, lost opportunity cost. Richard Cantillon discovered this in the 1500s. This is not new. Okay? So here's an example of the interest that you lose by paying cash. Now, my screen is very small. I hope y'all can see these numbers, but in the upper right, we're looking at a 30-year time period. I'm illustrating the ability to earn 5% on your money at a safe rate of return. I'm not trying to compare this to the real estate investment or any other investment. Okay. So we're looking at a 30-year time period, 5% earnings on your savings, and I'm illustrating a $30,000 cash purchase. I don't care if you bought a piece of real estate, an option in the real estate market. I don't care if you bought a piece of equipment that's going to cause your business to be more profitable, or you bought an automobile. Whatever it is, you get all the benefits of that purchase, right? But if your $30,000 was earning 5% over 30 years, in the lower right, it would have grown to about $129,000. But you have whatever it is you purchased, so you subtract $30,000 out of there. Now we've isolated the financing cost of paying cash over a 30-year time period. It's $99,658. Does that make sense? All right? Because as soon as you make the cash purchase, you don't have that money, it will never earn interest for you again. Right? But if it was earning interest, I'm isolating the cost of paying cash. So the question here is, do you know that it is possible to capture or recapture the equivalent of that lost interest? I'm telling you it is. And if you would like to, this is the concept that you need to investigate, learn, and just implement into your life. Because you can capture the equivalent of that lost interest. And you can capture it tax-free. Okay? So how many would like to capture that lost interest if you could? Well, how soon would you like to capture that lost interest? As soon as it made sense to you and you can wrap your mind around it, right? Of course. Okay. The second concept you have to be okay with is the banking process. Nothing new. We're all banking every day, right? We're all banking every day. My example here, and I'm a generous guy, I'm showing a $100,000 deposit into a bank, and I'm showing that they're going to pay you 4% on that deposit. See how generous I am? That's generous, right? Of course it is. Well, the PowerPoint's a couple of years old. Concept's still the same, and at the end of the day, I don't care what the interest rates are. Interest rates don't matter when you understand this concept. And that's a powerful statement. Okay, here's the question. Do you know what the bank is going to do with your money? No, the bank. No, that is correct. Your money. They are going to lend it out. But before they lend it out, they're going to create money out of thin air because the banks don't lend their money. You're exactly right. The banks don't lend their money. It's Tier 1 capital. It's too valuable for them to lend. Their money's on guaranteed deposits, earning guaranteed interest rates. They lend your money after they inflate it out of thin air. So in essence, they're really lending money that didn't exist. They're creating this money that didn't exist with your deposit. Think about that. That's almost criminal. Right? Okay, but let's look at this banking process. Your deposit goes in, the bank inflates that deposit, and then creates loan portfolios. I've created 6 loan portfolios, and I've assigned interest rates to them. Okay? Now, if we look at that, I put 8% on an automobile loan portfolio, 5% on a mortgage, 9% on a line of credit, 8% on equipment, 8% on construction, and then commercial real estate I put 6. Man, we can move those interest rates up and down all day long. I don't care. It's not about interest rates, but I assure you that I have, driving over here this morning and driving home this afternoon, you're going to pass cars on the freeway that are financed at 10, 12, and 14%. right? Pre-owned automobiles don't get that 0% interest rate that they advertise. All right? Okay, now, we know that some of these notes are going to be called, some are going to be defaulted, and some are going to pay off early, and the remainder is just going to pay on time as scheduled. All right? Okay, now I'm going to add up these interest rates, and it gets to 44%. Now, the bank's paying you 4, and they're earning 44 in a straight, linear, simple math. The question here is, how much more is the bank earning on your money than you are? A lot's probably the best answer, but can I have some numbers? 40. 40 is the most common answer, right? And it's wrong. A lot's, more accurate, but, undefined. What? Okay, so look, I'm saying the bank's making more than 1,000% in my example right here. And I'm wrong too, because they're making about 1,800% in this example. But let's just check the math. How do we get to these numbers? Well, this is how you got to 40. 44 minus 40 equals 40. Well, Neathery, how did you get to 1,000? Here are the keystrokes. Simple calculator. 4 times 1,000% equals 40. All right? All right. Now look, the bank's doing something that you can't do. There's no question. They're inflating money out of thin air. That's a federal offense. You'd be in Sing Sing or, under the jail, right? Counterfeit, whatever they call it. We can't do it. They can. I don't want to do anything illegal. There's nothing illegal about this. But every one of y'all drove here in an automobile. And every one of y'all are going to drive home in the same automobile. Your significant other, your children probably have automobiles, and you probably purchased their first one. Y'all been driving for 15, 20, 30 years. You're going to continue to drive 15, 20, 30 years. Right? All right. And I bet you none of y'all have slept in the rain unless you wanted to. Unless it was by choice, y'all are not sleeping in the rain tonight. All right, so you've all got a mortgage, had a mortgage. I don't care if you paid cash or you formally financed it. I don't care if you stay in a 5-star hotel. Somebody financed that, period. They either use somebody else's money or they paid cash and lost the interest they could have otherwise earned. All right? Okay. So you can't print money out of thin air, there's no question. But you can create a bank, an aggregate of money, and then you can put that money into motion and finance every major purchase in your life. It's called velocity of money. All right, have y'all heard that term? It's an economic term. When you put your money into motion, you're adding velocity to your money. All right, so if I pile money up into a life insurance policy and I'm calling it a bank because I'm going to practice banking and it has all the characteristics of a bank, can I finance my own automobile and my wife's automobile and my children's automobile and my neighbor's automobile if I wanted to, and then the next automobile and the next automobile and the next automobile and the next automobile? And I can do that with all the same money. If you look at a banking system as your personal economy, you put money into your personal economy, and then you finance everything that you were going to finance anyway through that bank. You've captured that money that it took to capitalize your bank, and then you've captured and maintained and kept control of all of that money that you have continually used financing over your lifetime, everything that you were going to finance anyway. Does that make sense? It does. Okay. So, can't print money out of thin air, but you can finance everything from a banking system that you were going to finance anyway. And you finance everything you purchase. You either formally finance with somebody else's money or you pay cash and lose the interest that you could have otherwise earned. All right? Now, this is the only trick question that I have. Who would you rather be, the bank or the borrower? The bank. All right. Of course you want to be the bank, right? The bank controls all the loans. They control the loan process. But it's okay to be the borrower. The borrower has a need for capital, right? So you really want to be both. You want to be the bank and the borrower, right? All right, well, here's the trick part of the question. You also want to be the bank owner. He's not on here. That's why it was a trick. All right. The bank owner made all the profits. The banker controlled the loan, and the borrower needed access to capital. You want to fulfill all those roles. Now let me ask you, how many of y'all have received a dividend check from your bank? Did you know your bank pays dividends? They do. They just pay them to the owners of the bank. You don't own the bank, so you don't get the dividend. They just pay you a modest amount of interest while your money's there. And as soon as you take it out, they won't pay you anything. All right? Okay. Baseline of 0. And this is cash versus formal financing. Look, most people don't have any money. Right? They can't start a bank. The capital stock of a bank is cash. Right? Okay, this is not y'all. Y'all are above average, right? The average guy on the street out there, he doesn't have any money, so he has to borrow money from someone else, someone who does have money. Right? So he borrows the money and then he makes payments. He still didn't save any money. He's undisciplined. He's going to make another purchase. I don't care if it's an automobile. I don't care what it is. But he makes another purchase. He doesn't have any money. He uses somebody else's money. And he pays them back interest, payments over time. That's how he lives his life. Right? Y'all have renters like that? All right. Well, you take the guy who has some discipline. He don't want to pay any interest to anybody. So he saves up a ton of money. Right? Did you know you got to have cash before you make a cash purchase? Right? Okay. This is a guy saving up the cash. Then he makes a cash purchase. But he's disciplined. He's always going to save money. He's going to save money his whole life. So before he makes his next cash purchase, he saves up money and then makes the purchase. That's how he spends his life. That's his spending pattern, right? Now look, both these guys end up at the same place. Right? All right. Now, you know, anytime you put money anywhere and it has a rate of return and time, you create an exponential curve. Right? And anytime you've created an exponential curve and you take money out of that place, right, you put money in, I don't care if it's your IRA, 401k, checking account, savings account, investment account, I don't care where it is. When you put money in there and there's an interest rate or some kind of rate of return in time, it will compound, right? The exponential curve, the more time that it compounds, the greater it grows to. Now, if you take money out of that account, you have retarded the compounding, right? You have stunted the curve. Does that make sense? Okay. If you put money into a life insurance policy structured correctly, that's liquid, you own it, you control it, and you use that capital to finance everything that you were going to finance anyway, which is everything you purchase. When you put the money into the policy, you've created an exponential curve. And then when you take money out of the policy, you don't take it out through withdrawals, you do it collaterally. Right? You're borrowing money against the cash value that's growing. And when you do that, you don't interrupt the compounding of that exponential curve. Does that make sense? All right, perfect. So we're just going to put this spending method onto an exponential curve. Cash flows didn't change. You know, the guy saved up money, collaterally used that capital while it was still earning interest and dividends, made loan repayments. The money's all there. He's his own banker. All the loan repayments went to him. So you're putting the same spending pattern on the exponential curve. That makes sense? Easy peasy, right? Now I'm going to beat you up with some numbers. All right? I know these numbers are little. I don't know how they look out there for y'all. And I know there's a lot of numbers on the page. I just want to isolate a couple. Okay? All right. This is right off of a ledger of a real life bona fide life insurance policy. And the guy, I believe, is 39 years old. Julie, do you have these sheets anywhere? I mean, I can strain with the best of them, but I'd rather not. All right. Okay, so here, when I mention the word life insurance, most people's mind slams shut like a steel trap, right? Oh my God, life insurance. The older you are, the sooner that happens. Now I'm able to see what y'all see. All right. Okay. We're looking at a 39-year-old guy, just standard non-tobacco. This is nothing special. This is a whole life policy, a whole life insurance policy. The guy pays $20,000 a year in premium. At the end of the year one, he has $500 in cash value, but he has $1.1 million in death benefit. It takes this guy 17 years before his $20,000 a year in premium is accessible 100% in cash value. This is what people, and this is really a good, strong life insurance illustration, but it's typical life insurance. This is not what I'm talking about. I'm taking the same 39-year-old gentleman, and this guy happens to be a real estate investor. Oh, look, it blew up. How's that? Did that help y'all? All right. So look, here, just conceptually, the guy's paying $20,000 a year in premium. He's got $500 at cash value at the end of the year. He's got a big old hunk in death benefit, $1.1 million, and all of that's going to grow. The cash value and the death benefit is going to grow. But the cash value is going to take 17 years to grow, where it equals 17 years of $20,000 a year in premium. Okay? Is that a bad deal? Not necessarily. What am I talking about? I'm talking about the infinite banking concept, which just structures policies for cash, not the death benefit. That's the first paradigm shift in thinking. We've all been taught to buy life insurance with the least amount of premium and the largest death benefit you could buy with those pennies you're trying to throw at the insurance company. Right? The exact opposite. I want to buy the least amount of death benefit that I could possibly buy, and I want to put as much cash in as I can possibly put in, and still maintain the preferential tax treatment of life insurance. Oh, did I mention life insurance was tax-free? Forever and ever, no matter what the brackets change to? Look, that's powerful. Taxes and inflation are the greatest destroyers of wealth, period. When you can operate in a tax-free environment and mitigate or eliminate inflation, you'll win without chasing rates of return. And that's exactly what I'm talking about. So this guy, same guy, $20,000 in, but now he has $13,200 in cash value at the end of the year, but he only has $577,000 in death benefit, not $1.1 million. All of the expense of life insurance is in the death benefit. All right? The majority of the expense of life insurance is in the death benefit. We're just trying to buy the least amount of death benefit as possible. All right, so now this guy, I'm illustrating $20,000 a year premium. The guy doesn't have to do that unless he wants to. When he understands what goes on in a life insurance policy, I guarantee you he'll want to. But let's say he doesn't. This is the same illustration. Now I'm illustrating that $20,000 in premium going away after year 7. You see the third column from the right, $20,000 a year for 7 years, and then it drops down to $66.25 a year. You see that? Is that blown up? Okay. All right. All right. Well, look, you go about 6-7 columns over, and you see $66.25 coming out of the policy. The policy is paying for itself from the policy values. This guy is not writing a check for it. All right, but he has, second column from the right, access to $130,000 in capital. You know, you go qualify for a loan. You tell me the hurdles you have to jump through. Don't tell me you're a real estate investor and you get 80% loan to value when you've got 30 properties. Right? I just bought a property, the office building right next to us, right? I called the insurance company, 2 signatures, mine and my wife's, Texas. Community property state, right? So she has to sign whether I want her to or not. But she knows what she's doing. 2 signatures, 1 page, and I get a check. I control the banking function. I'll tell them when I'm going to pay it back, if I'm going to pay it back. Right? Okay. But now you created a pool of... Look. All right, I can prove it, but I have put money into a policy and taken money out of a policy in 5 business days. Did we get a commercial loan back? I put money into the policy, wire transfer, my institution to their institution. They've got to process that premium, and then they've got to process a loan. Right, and I think I had them mail me that particular check that I'm talking about. You can get money out of this policy within 3 business days. Is that always the way it is? No. But 7 to 10 days, man, and that's worst case scenario if your mail guy loses the mail. and we have to reissue a check. It's quick. And thanks for asking that, because you tell me what's king in real estate besides location, location, location. It's cash. Cash is king, right? You can have the best deal in the world. The best opportunity in the world can be before both of us. It's the person who shows up with cash first wins. Isn't that right? Cash is king. Cash will be king. And cash has been king. That's why we're building these policies for cash. Right? Because it's what you can do with your God-given abilities and talents in the real estate industry that gets your great rate of return. But who's controlling the banking function in your life? Right? And you can control it very efficiently with this system. All right, now do y'all see that this policy is paying for itself in the 8th year and beyond? The guy's not writing a single check. All right? Now look at second column from the right. At the end of the 7th year, the net cash value, he has access to $130,000, right? Now you tell me what you can do with real estate in the real estate business with $130,000. Can't you go make 10% a year? Right? Can you? I don't know. Tim, can you go make 10% a year in the real estate business? I think so too. Man, I got clients, they won't even do a deal unless it's 20%, period. Right? Okay. But just play a little numbers game right here. And he's golden. This guy's put money in. He's got the real estate. Now he's created a real estate cash flow, didn't he? Isn't that the reason y'all are in real estate? It's real property and cash flow. And there's a deferred benefit sometime. You're either going to equity strip or you're going to give your property to your beneficiaries or your legacy, right, with a step up in basis tax efficiently, right? Isn't there a deferred benefit with real estate? Let's look at life insurance this way for a minute. It's nothing but real property. There's cash flows, and then there's a deferred benefit. It's just called a death benefit here, and it's all tax efficient. Okay? Now, here's the example. There's $130,000 in cash value. Can't that guy go generate $6,600 a year off of that real estate deal? Of course he can. If he can't, he's not the member of the right real estate group, I guess. Right? Or I don't know. He maybe should do something else. All right, so now we're looking at it. This is the very same illustration, but now I want you to go down to the 7th year. Second column from the right, he's got the same $130,000 in there. Right? Cash flows are the same in the first 7 years, same cash value. But now in year 8, he decides, since he's got that real estate cash flow, that he wants to pay the premium. He don't want the policy to pay its own premium. Does that make sense? Now he's writing a check for that premium. We're looking at year 8, third column from the left, $6,625 is the premium. Now I want you to go third column from the right in year 8. There's a $10,597 increase in cash value that year. And the only thing he did was put $6,625 in. Now you tell me if that's a cash flow in, premium in, and you make a loan out, isn't that a cash flow in and a cash flow out? Isn't that a cash flow in and out? Okay. That's what I want to focus on for the next few minutes is a cash flow. Now this guy, at the end of that first year, he's 40. I want to go out 15 years to his age, 54. And I don't care how old you are and how young you are. This concept is in fact outstanding at any age. Okay, but let's go out to age 54. He put $6,625 in. Third column from the right. Can y'all see that number? $15,502. He put $6,625 in, and there's $15,500 increase in cash value. And look, the previous year he could still have $217,000 outstanding in loans buying more real estate that causes him to have a greater cash flow. And if you put more money in on this left side of the page, $6,625, this number that I'm isolating on the right side of the page, third column from the right, would be bigger. Y'all know where you can put $6,625 today and see a $15,500 increase in 12 months? Because from the left side to the right side of this page is 12 months. All right? I don't either. But if I have real estate and it's cash flowing, and I stick a dividend-paying life insurance policy right in the middle of that cash flow, aren't I amplifying those cash flows? An incredible amount. Now you got all that money in that qualified retirement plan, right? Because you've been doing self-directed IRAs. God bless you. At 70 and a half, you have to start making withdrawals, right? You don't have a choice. All right. I don't know what the tax bracket's going to be, but I bet you're going to be in a big tax bracket, right? Unless all that money was in a Roth IRA, and it's not going to be. Let's be honest. At 70 and a half, this guy's showing a premium of $62.95. Some riders have come off. $62.95 is the premium. You know, you'd probably have to earn about $18,000 31 years from now to enjoy $6,200. I don't know. All right, $6,200 goes in. Third column from the left, there's a $26,500 increase in the cash value. Is that keeping up with inflation? It's incredible. Yes. I told you I'm asking easy questions. Yes, it keeps up with inflation. Now I get the real estate. I get all the benefits of that. I get all the cash flows from the real estate, the step up in basis, you know, when I do legacy planting, you know, planting seeds in gardens that you don't get to see the fruit from, right? Your grandchildren. All right. I get that. Plus, I get the ability to leverage my cash flow without risk in a private asset that I own and control, that's judgment proof, that's operating like a pre-engineered tax-free trust. Right? I get the real estate, the cash flows, the passive income in retirement, and the ability to leverage it. Life insurance designed this way is not an either-or asset. It's an and asset. I get that and that and that and that and that. Does that make sense? Pretty easy. Okay. I believe there's just some other illustrations. I can beat you up with the numbers. You get the point that I'm trying to explain here, that you put money in, you have access to it. And then the more money you put in, the more capital you have access to, and the greater the greater incomes or cash flow streams you can leverage. All right. All of y'all have an opportunity. I'm going to bring Nelson Nash to Fort Worth, Texas on July 23rd. Right, and it's we serve lunch and dinner. It's going to be Fort Worth, Texas. Y'all need to register for this if this has any interest to you. Okay, every one of y'all. I think we're giving away these DVDs at the back of the room. Look, this DVD is called Banking with Life. This is a documentary style film, completely unscripted. It's not a promotion of me or anybody. It talks about this concept. Two of the top Austrian economists in the country are in here. Nelson's in here. Businessmen across the country are in here. There's some financial guys that are in here. And then there's some everyday people like you and me. Some real estate investors, some doctors, some dentists, some retirees. Unscripted. This sells online all day long for $14.95 plus shipping. All right, it's 52 minutes, and it's well worth viewing. And then everyone in here should buy this book, Becoming Your Own Banker. I think we have them available. I'm not giving them away, but I'm not making a profit on them either. What are we selling these for? $15. I've got $15 in them, buying them and shipping them and then storing them. This is a deal for y'all only because you're here with Tim's group. Okay? All right, perfect. Any questions? Awesome. Well, I appreciate y'all. Y'all been a very good audience. Thank you. Thanks for watching. If you enjoyed the video, leave a like, and if you think it was helpful, share it with a friend. If you want to see more videos like this, then subscribe down below and click the bell icon so you can be notified when we release new videos. And we are releasing new content all the time. Don't miss it. Thanks for stopping by.